Welcome back, everybody. Today we're going to do a Walmart analysis. And now, over the past 5 years, Walmart has gone from 33 up to 59. It's an 83% gain in the past 5 years. This basically means that they kept pace with the S&P 500. They didn't do worse than it. They didn't do better than it, especially with the dividend yield of 1.4%. That's pretty much the same as the S&P 500. So yeah, if you bought Walmart, you'd be keeping pace. Now is it like overpriced at this point? Let's check it out. Now they are almost $500 billion company at this point, and their price to earnings ratio is 31. Is that concerning? That is a bit high. So let's see what the numbers really have to say about this. Checking their financials. Let's check their last 6 years. They went from 500 billion in revenue up to 650 billion in revenue. Seems like it's pretty low growth. Over the past couple of years, they did grow by 6%. Could probably be attributable to price increases. So I wouldn't put too much stock into that growth. Most likely just keeping up with inflation. Yeah, I'd say probably moving forward, you're looking at like 5% or 4% growth year over year for the foreseeable future. In terms of their income, they do have fairly consistent margins. Their margins are very thin. Paper thin, in fact, so that is something we'll have to watch out for. In terms of their balance sheet, they do have quite a bit of debt, 51.45 billion in net debt, and we'll have to put that into the cash flow model when we get to that. In terms of their cash flows, they buy back some stock. Actually, they bought back a lot of stock in 2021 and 2022, and last year they didn't buy back like any stock. Or I mean, they bought back 3 billion, so it's still some stock, but they didn't buy back quite as much as 2021 and 2022. And that's probably smart. In terms of their cash dividends, they paid a lot in dividends, and well, actually they bought back more stock and paid out more dividends than their free cash flow. So they probably had to take on some debt. They did take on some debt for that. Probably they just had a bunch of cash on the balance sheet that they had yet to pay out. In terms of when they did their buybacks in 2021 and 2022, they bought back tons of stock. We can actually check in 2021 and 2022, their price basically stayed right around like 43 up to like $50 a share. So it seems like they are buying back stock right around that $45 level. So I would say if Walmart ever drops back down to that $45 level, that could probably be a buying opportunity, especially since it seems like the company really likes to buy back stock at that price point. But moving on from that, let's check out the analyst estimates on this company. We're looking at 235 in earnings per share for this year, and the next year 259, and for revenue going from 673 billion up to 700 billion, which is like a 4% increase. I plugged that into my DCF model. Let's go to that. Here we go. Put the EPS estimate here, revenue estimate here, buybacks, net debt, discount rate of 10%, exit multiple of 20. Is that a fair exit multiple? I do think it is a fair exit multiple for a retailer. Now, Walmart does have quite the moat. Nobody can really compete with them in terms of price, except for, well, yeah, I'd say their price points are super attractive. Now, Walmart, I mean, it doesn't really have the greatest reputation in the world, so I do think that 20 is fair. You might be able to go with like a 22. Right now they're trading at 31, so yeah, right now it's pretty steep. In terms of growth, I put their earnings growth at 4%, and in this case, we're at between $36 and $42 a share. I'd probably put their fair share price right around $40 a share. And for their revenue one, I put their revenue growth at 4% and their profit margin at 2.5%. That is historically what they've done. It's definitely possible that they're able to grow these profit margins up to 3%. I don't really see them going past 3%, but it's possible that they go up to 3.5%, I guess, but never past 3.5%. In the case that they are able to grow their profit margin up to 3%, which is realistic, we could probably expect their fair share price to still be around like $42, which is still quite a bit under the price right now at about $60. And that's if you want a 10% return. Now, if you're okay with having less of a return, then this is probably a safe stock. So maybe if you're okay with a 6% return, yeah, probably like a 5 or 6% return you'd be expecting from Walmart at this point. Assuming that this projection comes true, where they have 4% growth and they can get up to 3% margins, which honestly I don't even know if they can make it up to 3% margins, but if they can, then this is the fair value. It's also possible that they make it to 3.5%. You guys should just let me know in the comments what you think. Maybe you do think that they can make 3.5% margins, and in that case, you can actually try this spreadsheet for yourself. Just check the link in the description. I let anybody use it for free. I literally just built this using like the Google Finance stuff. So yeah, try it out for yourself. Also, yeah, subscribe and hit that like button, and I'll see you in the next video.